Hello, everybody, and welcome to another session where we will be analyzing the financial statements of a business. And today we're going to be looking at GS Technologies. So GS Technologies, to introduce you to the company, they are responsible. I'm going to read this out because it's quite long. GST provides optimal wireless electronic cabling, security, and other solutions to clients operating in the infrastructure development space. GST builds on the profitable ICT business of its Singaporean subsidiary. So it's a very important point about this profitable business, EMS Wiring Systems, which has been supplying governments and large private organizations with intelligent building solutions for the last 30 years. GST's strategy is to develop solutions to meet the needs of the ICT industry, acting on the surging opportunities in technology, innovation sectors, data centers, intelligent buildings, smart cities, and the Internet of Things, particularly targeting emerging markets where the demand for ICT infrastructure is increasing rapidly. So there's a quick overview of what the company does. It's really a play on the future technology opportunities, the Internet of Things, the smart everything, the smart cities. Think about NEOM going up in Saudi Arabia, for example. So we are looking at this company courtesy of Lanray. So please can you do a video on Cellular Good, which we will be doing separately, and GS Technologies. So this is for you, Lanray. Hopefully I've pronounced that correctly. So there's an overview of the business. Let's dive in and look at their financials. So here we go. Let's have a look at their financials. And here is GS Technologies, formerly known as Golden Saint Technologies. So there is the GS for you, in case you were wondering. So we'll whiz down straight through to the profit and loss account as our first port of call. And we notice that this company, the sales have fallen. So let's look at the top line here. We're looking at the revenue line. We're in dollars in millions, and it has fallen from about $6.7 million down to $4.5 million. Now, $6.5 million is not very large. So this is a relatively small company on the kind of global circuit, and they have seen a fall of about 32% in terms of their top line. And that is probably going to be directly related to the pandemic. You'll notice that they have no cost of sales. So this is really meant to be a fixed cost business, and the costs of the operations are in here. And they have also fallen from 6.7 million down to 4.8 million, which means that they are operating at a loss. Now, the loss has dropped. So they were making a significant loss in 2019. And they have managed to kind of reduce that somewhat in 2020 from 369,000 to 255. That's about a 6% operating loss. We'll notice that they have some income tax, and you'll notice also this 350,000 in the previous year was the impairment of goodwill. Now, just so we understand that, so impairment of goodwill is where we happens on the acquisition of an asset, where we buy a company for more than its net book value. And impairment means that we've actually written down that goodwill. So it looks to me like, you know, in the past they bought something, it's not worth, they bought a company, it's not worth what they thought it was, and they've actually had to write it down. That was in 2019. So our conclusion here, this is a company, it's shrunk. We're hoping that it can come back in 2020-21, but it has shrunk as a result of the pandemic, and it continues to be loss-making. Let's go and look at the balance sheet and see how strong it is. So when we look at the balance sheet, first thing we're looking at is the non-current assets. So the non-current assets, if you remember, are the things we need to run the business. And you'll notice that these are really, really small numbers. So previous year, it was 183,000, and now it's up to 300,000. So in effect, this company, it doesn't really need any assets, investment assets to run. This is very much a working capital. And here's our working capital. And you'll see that that working capital has dropped from 3.9 million down to 2.3 million. The big number in here is their trade and other receivables, which has also fallen. And you'll notice here, this is a key number here, this cash on the balance sheet. How much cash have they actually got? And that has fallen slightly as well. We really want to be comparing those current assets. So the current assets are things that we own, that we either going to become cash soon, so things like inventories and work in progress, where they're working on contracts, or trade receivables, where they're due the money, or are actually our cash. So things that are going to become cash or which are cash, and we might compare those to the current liabilities, and actually the current liabilities are very small indeed, only 674,000 and only 1.7 million in the previous year. So our conclusion, balance sheet, and actually we notice on the non-current liabilities, they've effectively got nothing. So there's no debt funding this business, which is good. There's no real liabilities, but it is shrinking. The balance sheet has shrunk in relation to or as well as the overall turnover. So this is a company that has shrunk. And if we see the equity, we notice that they have been raising some money. They haven't done any share issues recently, and they have historically been making profits, but those profits, the retained profits, are falling due to the loss they made in the year. So they have been profitable in the past, and they're hoping they can be profitable in the future. If we go and look at the cash flow statement, now this I found actually quite interesting, the cash flow, mainly because of their ability to add up, which I thought was a little bit interesting. So what we've got here, this top section is all about turning the operating profit or loss in their case, so the operating profit, and turning it into the cash equivalent. And here we see the cash equivalent. The problem is, in the previous year, this 455, this is a sum total of these numbers here added to 345. So if we add these two numbers together, we get 455. Unfortunately, if you do the same on this side, they don't add up. So if you add up these numbers, you get 95, and you've missed out this number up here. So actually that 95 is wrong. Okay, so we'll just put a big arrow through it. So that is a wrong number there. This has been signed off by the auditors, by the way, so they missed this one. So that number there should be 246 negative. Okay, so the net cash used in the operating activities, 246. There it is, dollars, $1,000 K. Okay, and it's a negative number. That's what it should be compared to the 455. It's less than the previous year. We'd expect that because they are, it's a shrinking business, yet they're still operating. They're underlying, they're operating at a loss, which is not good. We also might just look at these numbers here. So it's quite interesting looking at these two numbers here. This is the movement in the trade receivables and trade payables. So this is what's called working capital in effect. And I'll explain it to you what's happening here. So this negative number says increase. A negative number is an increase in trade receivables. It's effectively saying that the amount of money they're owed by their customers has gone up, so they have 960,000 less cash. And exactly the same below, it says the amount they owe to their suppliers has gone up by 1.15 million, and therefore they have 1.15 extra cash. And what we see, interesting enough, is that these two numbers are almost exactly reversed. So they've managed to collect an extra 941,000 during the year, which gives them a positive effect on their cash, and they've used the money to pay their suppliers of 1039. They've reduced their liabilities by 1039, and that's had a negative effect on the cash. So the net effect of those two numbers is relatively small, and it may be just that this is timing differences on some of the big contracts that they have actually got in place. So I'm not too worried about those two, but what I am worried about is, first of all, the auditors can't spot the error in the accounts, and the fact that they are losing, they're burning 256,000 from their operating activities. And if you're burning 250,000 from your operating activities, and if we just pop back to our balance sheet to remind ourselves as to how much cash they actually have in the bank, there it is. So they've got 561,000 in the bank. You can see that, at that cash burn rate, they're going to run out of cash within a couple of years. In fact, we didn't have to go back up there, so the cash in the bank is actually shown to us in the bottom of the cash flow statement. There is that 561,000. In terms of investment activities, there was a little bit of investing going on in the previous year. We can see that here. They were investing 346,000, and in additional, so this is in work in progress, which they can then effectively sell, and they've got their property, plant, and equipment. So you know, this is a kind of a reversal in effect of their work in progress. So this number here becoming a positive number here. Okay, so we can see that there's no, they're not effectively investing, and the previous year there was a share issue going on. So they did do a share issue of $1.6 million, and the aim is that, you know, that gives them enough firepower to survive, to actually start to, you know, generate a profit and generate cash. That is their aim. So there is kind of, you know, that's the kind of the key analysis. You know, it's you know, it's a challenging environment, and actually this is reflected in their accounting policies. So here we go. I'm just going to highlight this one here. This is the most important. This is going concern. So going concern describes, can a business is it trading, and can it continue to trade for the foreseeable future? They are assuming that they can trade. There they go. They talk about the cash reserves. They've got 561,000. And this point here, the directors are confident that the group will generate revenue from data and technology services, which will contribute to cash flow in the next 6-month period. On this basis, the directors believe there are sufficient funds to meet the group's working capital requirements. And they recorded a loss, and it talks a little bit about the loss in net assets, which we've already picked up. So this company, you know, it's kind of, you know, it's not particularly strong. It needs to get out there. It needs to secure the contracts. It needs to give a proof of concept. It's good that it's got a subsidiary which is profitable. What we can't see here is the extent to which a profitable subsidiary is making up for losses elsewhere in the group, and whether they need to start cutting those losses and focusing on only the profitable parts of the group. So let's go and have a look at their share price and see how this is reflected. So here we see their share price down the bottom. Now, what's interesting about this is that the share price, and this is as of today, recording this video, gives a P ratio of 78 times. Now, the fact that they give a P ratio means the company must now be making profits. Not a lot of profit, so it's still very expensive on that, but it suggests that it's managed to turn the corner and it's actually starting to make a profit. You'll see a very volatile share price, obviously something, you know, very exciting announced in February 2021, and I don't know, you know, if you do know what was announced around late December or January. I think that would have been what happened in January 2021 to cause the share price to spike. Then do leave your comments in the leave your thoughts in the comments box. So it spiked, and it's just been kind of drifting sideways and dropping since then. The market cap of 16.7 million. If you remember, the balance sheet is about just over 2 million, or just under 2 million. It's about 1.9 million. So, you know, this is basically a goodwill company. It's pretty much all goodwill. You know, if you're buying into this company, you're buying into the story, you're buying into the fact that, you know, these guys can tap into that gold scene. And, you know, the Internet of Things, we talk about 5G, you know, maybe this is one of the companies that is going to benefit from that. I don't know. If you do know, if you've got some inside track on this company, then please do share your thoughts in the comments box. So there we go. GST, pretty interesting company. It's a small company. It's shrinking. We see the balance sheet shrinking, the revenue shrinking. It's not generating any cash. It's got a profitable subsidiary. The auditors can't add up, but that's a different story altogether. So yeah, interesting company. So thank you very much for watching this video. Please do like, share, and subscribe to the channel. If you've got additional thoughts on this company, anything you want to share with me or with our other viewers, then please do put your comments in the comments box. Alternatively, if there's any companies you want us to look at, then please again do leave them in the comments box, and I look forward to seeing you on the next video.